Infinite software, finite physics, follow the money with me. Software is becoming free. Sit with that sentence because it quietly explains three things that look completely unrelated. It explains why copper, the metal in your walls, set all-time price records this spring. It explains why power companies now have waiting lists measured in years. And it explains why the world's richest man just convinced Wall Street to fund data centers. In orbit, by the end of this video, all three will click. Here's the idea in one line. When I can write code instantly for pennies, software stops being scarce and markets only pay for scarce. So the money is sliding down the stack out of apps and into the physical world, chips, machines, metals, megawatts. The stuff you can't just prompt into existence. Q2's earnings were the first quarter where you could watch it happen in the numbers. Start with a paradox. The hype trade got cheaper while it went up. Everyone says AI stocks are a bubble, so look at what you actually pay today for next year's earnings. Micron 6.5 times 6, Nvidia 15, Meta 16. For reference, Coca-Cola, a company that sells sugar water, costs 24 times forward earnings. The scariest trade in the market is now priced cheaper than a soda company because earnings grew into the valuations. That's what a boom with receipts looks like. Now the uncomfortable half of the paradox. If models can generate working code on demand, what happens to the companies whose whole moat was the code? Their product becomes disposable, something you regenerate, not something you subscribe to for a decade. That doesn't kill software companies overnight, but it compresses what investors will pay for them one renewal cycle at a time. And the market has already started voting. Here's the vote drawn as two lines. Start both at 100 on January 1st. The blue line is IGV, the big software ETF, first half of the year, down 12%. The green line is SOXX, the semiconductor ETF, same 6 months, same market, same AI story, up 85%. Same narrative, opposite outcomes. The money didn't leave the AI trade, it left the software layer. So if code is free, what's scarce? Follow the bottleneck down the stack. First, stop below the GPU, memory, and the machines that make it. High bandwidth memory is effectively sold out. Micron ran an 84% gross margin on it, SK Hynix a 72% operating margin. Commodity businesses aren't supposed to print those numbers. And upstream of them, Applied Materials just raised its 2026 equipment outlook from 20% growth to more than 30%, citing token demand tripling in months. When the machine makers raise guidance like that, the shortage isn't ending, it's compounding. Go one layer deeper and the AI trade stops looking like tech at all, it becomes a commodities trade. This is copper in the first half, grinding at record territory, peaking near $6.60 a pound in May, levels no one had ever seen before this cycle. Why? Data centers alone may need 475,000 tons of it this year, more than 4 times last year. Silver went even wilder, up over 200% in 12 months at its January peak before giving a chunk back. You cannot prompt an LLM into producing a copper mine. And the forward math is brutal. Global copper demand is projected to climb 24% by 2035, and the mines simply are not coming fast enough. Analysts now project a 6 million ton annual shortfall by then. The IEA warns the gap could reach 30% of demand. Silver's already in a structural deficit. Demand outran mine supply by roughly 200 million ounces last year. This bottleneck isn't easing, it's widening every quarter. Beneath the metals sits the hardest wall of all, electricity. Data center power use is on track to more than double by 2030 in America. Data centers alone drive about half of all electricity demand growth this decade. Lead times for big transformers now stretch to 4 years, and more than half of the data centers planned for this year risk delays because the equipment simply doesn't exist. Look who won Q2, not the power sellers. Constellation fell 11%. The grid builders, GE Vernova up 35%, Powell up 59%. Scarcity pays the toll booth, not the traffic. And when a bottleneck can't be fixed on Earth, you leave Earth. Which brings us to the wildest earnings season story of the quarter. In June, SpaceX went public at a $1.77 trillion valuation, the biggest IPO in history. But here's what most coverage missed: the pitch wasn't rockets. It was Starmind, a plan filed with regulators for up to 1 million orbital compute nodes, with the first AI-1 data center satellites targeted for next year. Unlimited solar power, no grid queue, no 4-year transformer wait. The ultimate answer to finite physics: skip the planet. Wall Street's verdict so far, pure whiplash, and you can read the argument right off the price chart. Priced at 135, first close 161, 3 days later 211, euphoria. Then a slide all the way to the 150s as the doubt sank in, and a choppy recovery since. Every swing in this line is the same debate: is orbital compute the next Starlink, or the most expensive science project ever listed? And the funniest part, the loudest skeptic is SpaceX's own paperwork. Musk calls space-based AI a quote no-brainer. The S-1 filing says the plans involve, quote, significant technical complexity and unproven technologies and may not achieve commercial viability. Translation: cooling computers in a vacuum is brutally hard, there's no air to dump heat into. Our read treats Starmind as a lottery ticket stapled to the world's best launch business. The rockets are real today. The orbital data centers are a bet on physics we haven't solved yet, which, in this market, is exactly the kind of scarcity story that gets funded. Meanwhile, something strange happened to the giants everyone worships. The Magnificent Seven used to trade like rocket fuel. Look at them now next to the most boring stocks on Earth. Alphabet 25 times forward earnings. Coca-Cola 24, Microsoft 20, Procter & Gamble 21. The market has quietly repriced big tech as consumer staples, reliable, defensive, cash-gushing, and no longer priced for magic. In Q2, the megacaps mostly went sideways while the physical stack tripled. That's not an accident, that's a demotion. Why the demotion? Because their moats face the same solvent that's dissolving software. Search, social feeds, storefronts, they're all distribution. And distribution is exactly what conversational AI threatens to root around. If an agent books your flight and buys your detergent, who wins the ad auction? The staples label fits for now enormous cash flows, loyal users. The open question Q3 has to answer is whether that cash funds the next moat, or just a very comfortable decline. Zoom out and the winner's map doesn't look American at all. Korea owns the memory bottleneck outright. SK Hynix stock rose 228% in Q2 alone, running that 72% operating margin on HBM the world cannot get enough of. Samsung nearly doubled. When one country controls the scarcest input in the hottest trade on the planet, its market becomes the trade. Taiwan is its own category, don't lump it in with anyone. TSMC is the foundation the entire ecosystem stands on. It fabricates for Nvidia, AMD, and Apple at a 66% gross margin, grew 40% and reports July 16th, the single best preview of everyone else's quarter. One company, one island, holding up the whole stack. And China found a different door into the trade. Zhipu, the first large language model company ever listed, rode its Hong Kong IPO to a 200% Q2 and $1 trillion Hong Kong dollar market cap. Its pitch inverts the whole Western playbook, open-weight models like GLM 5.2 that claim near-frontier results at a fraction of the compute. Think about what that means. If the West's bet is scarce physics, China's bet is making the software so cheap the physics matters less. Both bets can't be fully right. Q3 starts settling it. So here's the thesis and the dates that will test it. One more time, the whole story in 30 seconds. AI is making software infinite, so the market stopped paying for it. Value is migrating down into everything that isn't infinite. Sold-out memory, 4-year transformer queues, record copper, and if Musk has his way, orbital solar farms running data centers where no grid can follow. Software ate the world for 15 years. Now physics is eating software's lunch. Every piece of this thesis has a court date. TSMC July 16th tells us if the foundry engine is still accelerating. Intel and Samsung the 23rd. The super week from July 28th, Microsoft, then Meta, ARM, and SK Hynix test both the staples story and the memory story. SpaceX's first ever earnings expected early August opens the Starmind books. Nvidia August 26th. Zhipu September 2nd. Micron closes the case September 29th. We'll be here for every single one of those dates, the numbers, the after-hours move, and what it does to this thesis, usually within the hour. If this breakdown earns 6 minutes of your day, the subscribe button takes 1 second and the bell makes sure the next inflection doesn't happen without you. And if you want the raw Q2 scoreboard behind today's story, the full quarter recap is on screen right now. See you July 15th.